Welcome to Amateur Investing. Today we are going over probably my favorite screener of all time. What if I told you you could have a diversified 6% gain every 3 days? That's what we're looking at today. But before we get into that, could you please like this video? Could you please tap that like button? Could you please click on that like button? Can we smash that like button?
Destroy it.
Hey, thanks for liking the video. And while we're at it, under 10% of my viewers are subscribed, so if you could hit that subscribe button as well, that would be awesome. Alright, time for the actual video. So I had made a pullback screener before, and when I tested it, it was able to get about 3% gains in 3 days. But I made this new one that I wanted to compare it to because I really felt that this new one was better. And what I found was that compared to the first one, version 2 had an average of 4.96% profit in 3 days. But when I referenced each screener, I also pulled out stocks that I would personally pick. I wouldn't just blindly pick stocks that the screener pulls, I would also use some personal analysis in it. So for version 1, this ended up being a 4.21% profit, and for version 2, that ended up being 6.09% profit. And if you want access to the spreadsheet where I recorded all of my testing, that link is going to be in the description below. Alright, so this is a pullback screener, but Richard, what is a pullback? So when I say pullback and I'm referring to stocks, what I mean is I'm looking for a stock that has a sharp dip in a price because then it's more likely to snap back up to the mean. So for example, if the long-term chart for a stock is looking something like this, in reality it's probably moving something more like this. So whenever it's below its trend line, it's likely to go back up to the mean, or the average price. So what the screener attempts to do is find stocks that have fallen and are primed to go back up to that mean. So before I go over how to make this screener, I need to cover a little bit of technical vocabulary. The first being candlestick charts and then an SMA. So when you're looking at a chart, let's say on TradingView, and everything's made up of these little bars, these bars are called candlesticks. Whatever that time frame is means that each one of these candles represents that amount of time. So for example, for a 15-minute chart, each candle is 15 minutes of time. Now what you probably could have guessed is that green means up and red means down, right? But what are these boxes and sticks all about? So the body of the candle represents the open and close price. For a green candle, because it's moving up, the bottom is open and the top is closed. So at the start of the 15 minutes, it's at the bottom of the candle, and at the end of the 15 minutes, it would be at the top of the candle. And the little sticks on the tops and bottoms of the candle are called wicks. And what the wicks represent is the high and the low point in the time period. So the very bottom of the bottom wick is the lowest point within the time frame, and the top point of the top wick is the highest point in the time frame. And this is the case for both red and green candles. What about the SMA? The SMA, or the simple moving average, is a technical indicator that shows the average point of X number of previous candles. So for example, the SMA 20, or the 20 period SMA, shows the average price for the past 20 candles. So for the 15-minute chart, the 20 period SMA would show the average for the past 5 hours. So with the simplest definition possible, the smaller the time frame for the SMA, the more sensitive the trend line is going to react. Okay, but Richard, how do I make this screener? So you're going to want to head over to finviz.com. That's Finviz.com. This is where we're going to build our screener. Now, if you want to make an account, you can. It's absolutely free, and doing so will allow you to save the screener so that you don't have to keep making it every time you come back. And as you probably could have guessed, at the top of the page on this bar here, you're going to want to pick the third option that says screener. So this gives you a lot of different settings you can pick and choose from, and whenever you enter these settings, it will search through every stock available that matches the criteria that you set. So let's go ahead and click on over to all, so we have every option available to us. So the first thing we're going to pick is up at the top where it says signal. Hit the drop down and click on unusual volume. See, big volume almost always means big movement, and as Wall Street Bets likes to say, stocks can only go up. So this is not investment advice, but if you're betting on a stock that has more volume than usual, there's probably a better than a coin flip of a chance that it's going to go up. Again, this is not investment advice. Don't follow that. Alright, the next setting that we're going to want to pick is down where it says performance, hit today down. This means that when you're running this screener, it's going to find stocks that are performing lower than the day prior today. But we don't want it to be down just a little bit, right? We want this to have the potential to go up. So next, we're going to go to 20-day simple moving average and hit below SMA 20. This is showing that it's not only down a little bit, but it's significantly down, more so than the past 20 days progress. Next, we're going to go over to 200-day simple moving average, and we want it to be above this one. So above SMA 200. This is because the big risk in this strategy is that the stock will not go back up. So if the pullback is too far, it might not snap back to where it was before. It'll just stay down or crash even further. Alright, now we're going to go to the RSI 14, and the RSI is another technical indicator. It stands for Relative Strength Index. It's based on the same concept of the reversion to the mean, and what it basically is a scale of 0 to 100, where the closer the stock is to 100, the more likely it is overbought, and the closer it is to 0, the more likely it is oversold. Actually, you know what? I don't know if it goes to 0 or 1, but you know what I mean. So the theory behind RSI is that there's always pressure to go back towards 50, where the stock is neither overbought nor oversold. And we want to have a stock that has bullish pressure, so we're going to go to not overbought. And we want the lowest number available being less than 50. Alright, next is beta. Beta is a measure of a stock's volatility relative to the market. And we want a stock that has some big schmovement. If it's not schmoving, we're not making any money. If a pullback that's far enough to go under the 20-day SMA is just like 5%, the net correction might only be 2%. And that's pretty lame. We want something bigger than that. So we're going to select over 1. Finally, for relative volume, just like how we picked unusual volume at the top, we're going to do over 1.5. Which just means that the stock's recent performance has more volume than what is typical. And that is it. That is the pullback indicator. Now, when I was looking at these results, I was trying to find out what all of the moneymakers had in common compared to the non-moneymakers. And what I found was that when the screener pulled these stocks, they were all above the SMA 50. So I also have a version 2.2 for my stock screener, where it's exactly the same as the last one you saw, except for it also has, for the 50-day simple moving average, price above SMA 50. Now, full disclaimer, I have not tested this nearly as thoroughly as I did the last one I just showed you, and in some cases it performs worse. So for example, I have this sheet called version 2.1 testing, that for the first screener I showed you, it actually saw a loss of a negative 3.15%, just selling blindly after 3 days, whereas 2.2 went down to negative 3.3, so slightly worse performance. If you're wondering what all these color boxes are, I was trying for the life of me to find some kind of trend other than the SMA 50, and I could not find any correlation at all. Now, it is important to note that in this 3-day period that I tested, when I calculated the quote-unquote perfect trade, where I subtracted the lowest point in the period from the highest point, version 2.2 did perform better, with a 12.30% profit as compared to a 9.18% profit. That said, you should never expect to have a perfect trade. There's no way to know what the absolute top and the absolute bottom of a trend is going to be. Okay, and finally, I'm going to tell you what I look for when I'm looking at the screener so I can make money off of it. This is not investment advice. I repeat, this is not investment advice. So the first thing I look for is a trend on the chart. So if we go back to Finviz and hit charts at the bottom, you can either look at technical or candle. Now, technical has a longer time period, but it also has a lot more stuff on the screen that might confuse you. So if that's the case, you're probably fine just sticking with candle. So for each of these peaks and valleys you see, you want these valleys to be getting progressively higher and higher. This shows you that over the long term, the stock is trending upward. Because if the pullback goes too far relative to the price history, it might not come back up to the trend. Also, if you can, you want to avoid what's called a wedge, which is where you're having higher lows but also lower highs over time, so it starts coming to a point. When you have a wedge, it leads to what's called a breakout, and you don't want to gamble if that breakout's going to be up or down. So when I'm going through here and I see a stock that looks good, I'll write down the tickers until I have a watch list, and then I'll narrow it down even further with news. So there are lots of different sources where you can get stock-related news. I like using Webull and Yahoo Finance. I know that Thinkorswim also has a news feature built in. And basically you want to pull up each ticker and see if there's any significant negative information relating to it. But minor negative news is not necessarily that bad of a thing, because there's usually some reason that the stock went down, right? We just want to make sure it's not going to stay down. So we're trying to avoid things like a company making a bad decision, or even things relating to publicity, like if a CEO made some off-color comment. So every time you see one of these red flags, take that ticker off the list. When you're done with this, you should have a set of stocks that have recently gone down, but not too far down, without any news that should hinder its recovery. Now, in the testing I did from the spreadsheets that I'm sharing, the data comes from literally just buying at close and then selling at close 3 days later. The most brain-dead thing you can do. There are plenty of ways to trade more efficiently than that, and I highly recommend finding a strategy that works well for you. Personally, I like utilizing Bollinger Bands on the 15 and 30 minute time frames, but I found that the results that this yields are far from the perfect trade, so I will not be sharing that strategy, at least not in this video. Let me know if the screener yields any good results for you. If it does, please share this with as many people as you can. Like the video if you did, leave a comment, and subscribe. See you around! Or even something relating to publicity, like if the CEO did something weird with kids.